As of today, Sunday, July 26, 2026, the U.S. stock markets are closed for the weekend. KEEL Infrastructure Corp., trading under the ticker symbol KEEL on the NASDAQ, finished its most recent trading session on Friday, July 24, 2026, at a closing price of $4.26 per share, down roughly 11% on the session after fluctuating through a daily range between $4.25 and $4.82. If you look at retail order flows across major platforms like the Robinhood app, SoFi Invest, and Fidelity Investments, retail traders have been treating this asset like a pure-play speculative crypto vehicle. The market belief surrounding this equity is simple on the surface. Most retail traders assume this is just another rebranded Bitcoin miner trying to ride the high-performance computing wave, struggling with volatile revenues and diluted share counts. But when you look beneath that surface narrative, the operational reality tells a completely different story that most casual investors are missing. While retail traders on Robinhood stock trading and SoFi stocks are focusing on short-term cryptocurrency swings, institutional funds using interactive brokers trading tools and Fidelity wealth management desks are quietly positioning around something much larger. KEEL Infrastructure is sitting on over 2.2 gigawatts of secured energy pipeline and established grid interconnections across critical high-demand power zones in Pennsylvania, Washington, and Quebec. In a market where giant technology companies behind NVIDIA stock, Tesla stock, and Apple stock are facing severe electrical grid bottlenecks to power their massive artificial intelligence infrastructure, access to energized megawatt capacity is quickly becoming more valuable than the hardware itself. The market expects a struggling miner, but the reality is an emerging landlord for next-generation computing infrastructure. Recent price action in KEEL stock reflects a massive battle between retail paper hands and institutional accumulators. Over the past month, the stock has surrendered nearly 30% of its value, driven by overall weakness in digital assets and broader market caution around speculative small-cap equities. Yet trading volume has remained consistently elevated, with daily turnover frequently crossing tens of millions of shares. This high turnover rate highlights a structural rotation in ownership. Weak hands who bought into the early summer speculative rally are selling out, while patient funds operating through individual brokerage accounts and interactive brokers' platform routing are absorbing supply at depressed valuations. When you track institutional filings, major global institutions including Susquehanna International Group, Morgan Stanley, and specialized digital asset funds have maintained active positions in the company. The recent execution of convertible debt financing options gave the company fresh capital to accelerate site conversions, but it also triggered immediate hedge fund short activity. Arbitrage traders frequently short the underlying equity while buying the convertible notes to lock in risk-free yield, creating artificial selling pressure on the open market. That technical selling pressure masked the fact that market capitals are willingly backing KEEL with long-term debt because they recognize the value of their underlying power interconnection assets. Comment below with how many shares of KEEL Infrastructure Corp. you currently hold in your portfolio, or tell me if you think high-performance computing centers will completely replace traditional crypto mining facilities over the next 3 years. To fully grasp why this tension between market perception and corporate reality exists, you have to look at how KEEL Infrastructure operates. Founded as a pure-play digital asset processing enterprise, the company built out specialized data campuses designed to run energy-intensive computing operations. They established physical footprints in regions like Moses Lake, Panther Creek, Sharon, Sherbrooke, and Scrubgrass. For years, their business model relied on validation calculations for blockchain networks alongside third-party hardware hosting and commercial electrical services. That heritage left the company with a fundamental financial burden, volatile quarterly earnings that swing wildly depending on global energy prices and hash rate economics. In prior fiscal periods, net margins dipped deeply into negative territory during lean operational cycles, leading many conservative financial advisors on Schwab Intelligent Portfolios and SoFi robo-advisor algorithms to flag the ticker as high risk. That historical legacy is why many self-directed investors looking for self-investing solutions or basic investment help skip over KEEL on popular investing sites. They see historical net losses on financial screeners and assume the business lacks a durable moat. However, the structural economics of computing have fundamentally shifted. Building a modern data center requires three critical elements: fiber connectivity, physical land, and massive electrical power capacity with grid approval. While anyone can buy graphics processors, securing 2 gigawatts of interconnected power in North America can take anywhere from 5 to 7 years due to regulatory backlogs and utility constraints. KEEL already owns those grid connections. By retrofitting existing facilities from low-margin crypto processing into high-margin digital real estate hosting, KEEL is transitioning from a cyclical commodity producer into a high-margin digital real estate operator. This structural transition directly addresses the core expectation gap. Wall Street currently prices KEEL based on its legacy operational metrics, applying standard small-cap technology discounts. But if you evaluate the company as an energy infrastructure platform, its valuation metrics look remarkably detached from asset values. The company carries a price-to-sales ratio that reflects public market skepticism, yet the replacement cost of its underlying energization capacity commands a premium in private infrastructure transactions. Looking ahead, the road for KEEL Infrastructure presents clear catalysts along with undeniable operational risks. On the bullish side, long-term commercial hosting agreements with major enterprise clients would immediately re-rate the stock. Moving from volatile daily operational revenue to multi-year fixed-rate enterprise contracts provides the predictability that institutional investors demand before assigning higher valuation multiples. Furthermore, as large-cap tech leaders powering NVIDIA stock ecosystems struggle to secure power for new clusters, legacy sites like Panther Creek and Sharon become prime candidates for lucrative strategic partnerships or buyout offers. Conversely, execution risk remains a serious hurdle. Upgrading data centers from basic air-cooled setups to liquid-cooled high-density AI configurations requires substantial capital expenditure. If management relies too heavily on equity offerings, share dilution could offset the gains realized from higher operational cash flows. Investors executing trades through Fidelity brokerage accounts, Robinhood Investments, or Interactive Brokers account dashboards must closely monitor quarterly capex discipline and debt service costs. For self-directed investors building wealth through an individual brokerage account, Fidelity IRAs, or active online investing, understanding the contrast between public narrative and physical assets is essential. The market currently views KEEL Infrastructure Corp through the lens of its past volatility, keeping the share price depressed near multi-month lows. Yet the physical reality of its massive energization pipeline positions it directly in front of the largest computing build-out of our generation. Whether you execute trades via the Fidelity mobile app, Robinhood cash management options, or Interactive Brokers fee structures, keeping an eye on how effectively KEEL turns its raw grid access into enterprise hosting contracts will determine whether this asset remains a speculative option or transforms into an infrastructure powerhouse. In summary, the market's expectation of KEEL Infrastructure as a volatile digital miner overlooks the high-value reality of its secured 2.2 gigawatt power footprint. While short-term price pressure and convertible debt hedging continue to create downside noise, the underlying structural demand for power capacity provides a strong long-term foundation. Navigating this stock requires cutting through market noise and recognizing where true asset value lies in the modern digital economy.